Thanks for tuning in to Markets.com. You're watching a company profile of FedEx. The package delivery giant was founded in 1971 by Fred Smith, who still serves as the company's executive chairman, president, and CEO. FedEx operates in 4 segments, those being FedEx Express, FedEx Ground, FedEx Freight, and FedEx Services. The company is listed on the New York Stock Exchange, where it is traded on the Dow Industrials and S&P 500 indexes under the ticker symbol FDX. In fact, in 1984, FedEx became the first company in the U.S. to report $1 billion in revenue within 10 years of startup. FedEx sees the 3 major areas where growth in revenues can come from. The first is expanding its foreign, domestic, and international express business. This makes complete sense because in the domestic express business, they are unrivaled and have a reputation for providing very reliable service. If they can leverage the reputation and fleet of aircrafts worldwide, they can quickly expand the size of their business, which is also a smart move as the margins are higher than with any other segments. Just a decade ago, FedEx made a decision to enter the freight carrier business. Since then, they have expanded this segment of their business by purchasing local freight companies and integrating them into the national network they have built up. Because freighters in the U.S. have not been known to be the most reliable, and as the parcel carriers have a reputation for quick delivery, such is why FedEx's freight business has expanded so quickly in the last decade. Growth in the domestic market can come from customers who shop online, as most of these individual packages are sometimes shipped overnight. This is a long-term growth trend that the company can take advantage of. And a final way that FedEx sees growth is through bundling its 3 services in the North American market. FedEx, along with rival UPS, are recognized as the best courier services in the U.S., and they now provide all 3 delivery services, believing they can extract more value from their customers if they choose to use all of those services. Unfortunately for FedEx at the moment, just like its main rival UPS, the company is highly dependent on the health and growth of the U.S. economy. As we saw from the lower forecast it gave in early December, the U.S. economy is not doing well and package delivery is weak. The numbers coming down are totally based on the U.S. economy, while a similar drop in estimates is expected from UPS. In fact, the U.S. economy is doing so bad that FedEx has not been able to take advantage of the DHL withdrawal from the U.S. domestic market, a move that was expected to allow FedEx to increase its domestic market share. In the long term, however, the company should still be affected positively by DHL's withdrawal. FedEx looks to be in a bad shape at the moment, while it seems that the company does not know how much of its business will be affected. The worst thing you can do with this company is believe that it is cheap on an earnings basis, because earnings are uncertain for this company, just like most others. With that said, this is another company that needs the U.S. economy to turn around, although in their case, the correlation is so high that there won't be a turnaround until there is some sign of economic growth. Thanks for tuning in to this Markets.com company profile. I'm Luisana Swigart.